You already decided the smart move is a state with no income tax. Florida, Texas, Nevada. Everybody says it. Pack up, head south, keep more of your own money. But here's the part nobody puts on the brochure. There's a state with an income tax that charges you exactly nothing on your Social Security, nothing on your pension, nothing on your 401k, and nothing on your IRA. No cap, no phase out. And most folks our age move right past it without a second look. Meanwhile, some of those famous no-tax states can quietly cost you more, not less, once the bills nobody warned you about land in the mailbox. So before you call the movers, let me show you what actually decides whether your retirement income lasts here or gets eaten alive. Which states leave it alone, which ones take a bite, and the trap that catches people who only read the income tax headline. Glad you're here. I'm Gus, and around here we cut through the stuff that's built to confuse you and talk straight, with the sources right out on the table. If you've ever looked at a map and wondered whether crossing a state line could save your retirement or sink it, this one's for you. Because where you live can swing your tax bill by thousands of dollars a year, every year. And the answer is not the one the headlines hand you. Here's how it really works. The mistake almost everyone makes is treating this like one question. Is this a tax-friendly state? Yes or no? That's not how the money actually works. There are really 4 separate questions, and a state can give you a wonderful answer on one and a terrible answer on the next. Question 1. Does the state tax your Social Security check? Question 2. Does it tax your pension, the one some of us were lucky enough to keep? Question 3. Does it tax the money you pull from your 401k and your IRA? And question 4, the one that ambushes people. What does the state quietly take back through property tax, sales tax, and insurance, even when it brags about no income tax at all? Hold those 4 in your head, because the whole game is right there. Start with Social Security, and here's some good news for a change. Most states leave it completely alone. For 2026, more than 40 states plus Washington, D.C. don't tax your Social Security 1 penny. The list of states that still do has been shrinking for years. This year it's down to 8, and West Virginia just fell off it. Then there's the pension and the retirement accounts. This is where states split hard. 9 states have no income tax at all, so they don't touch any of it. A handful more do have an income tax, but still wave your retirement income right through, untaxed. And the rest tax it, some gently, some not. And the 4th question is, the one that turns a no income tax bumper sticker into a more expensive retirement than the one you left. A state that doesn't tax your income still needs the money, so it comes for your house, your shopping cart, and your insurance instead. Let me put real states and real numbers on all 4. First, Social Security, since that's the one folks worry about most. 8 states still tax it in some form in 2026. Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. But read that list carefully before you panic. Most of those 8 don't hit every retiree. They use income limits, so a couple living mostly on Social Security and a modest pension often owes little or nothing. Vermont, for one, only starts taxing benefits once your income climbs past a set line. So even on this list, the bite depends on your income, not just your address. Check your own state's rule. I'll show you how in a minute. Now the bigger swing. Your pension and your 401k and your IRA. 9 states charge no income tax at all. Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming. Live in one of those, and the state takes nothing from your retirement income. But here's the reveal I promised you. You do not have to live in a no-tax state to get that same 0. 4 states have an income tax on paper and still exempt your retirement income completely. Illinois, Iowa, once you're 55 or older, Mississippi, and Pennsylvania. Michigan just joined them this year, finishing a phase-out that now leaves most retirement income alone. Take Pennsylvania. It has a flat income tax of 3.07%. Sounds like a state you'd cross right off the list. But Pennsylvania's own Department of Revenue exempts your Social Security, your pension, your 401k, and your IRA withdrawals from that tax once you've reached retirement age. Add it up, and a retiree living on those checks pays the state 0. Same as Florida. Same as Texas. With the grandkids, maybe a whole lot closer. There's one honest catch, and I won't skip it. The magic word is qualified. In Pennsylvania and Mississippi, if you tap that money early, before age 59 and a half, the state can treat it as regular income and tax it. The exemption rewards waiting. Pull it early, and the rules change. And Pennsylvania isn't a clean sweep either. It still has an inheritance tax your kids could face on what you leave behind. So weigh that part too. Now question 4. The trap. You've heard no income tax your whole life like it's the finish line. But a state with no income tax still has bills, and it sends them to you in different envelopes. Texas and New Hampshire have no income tax and some of the highest property taxes in the country. A paid-off house doesn't feel so paid off when the tax bill runs into 5 figures every year. Tennessee has no income tax either, but it carries one of the highest combined sales tax rates in the nation, second only to Louisiana, north of 9.5 cents on the dollar. That's a tax you pay every single time you check out at the register, all year long. And Florida, the most popular landing spot of them all, no income tax, written right into the state constitution. But Florida now has the highest home insurance in the country. The national average runs around $2,500 a year. In Florida, depending on whose figures you read, the average runs from the mid-4,000s to over $7,000 a year, and a good deal more near the coast. A couple who saves $3,000 skipping income tax and then spends $5,000 more to insure the house didn't save a thing. They lost ground. And this is the part that lands different for our generation. We were promised a pension and a gold watch, and then a lot of us got handed a 401k instead and told to figure it out ourselves. Now, after all that, the state line you happen to retire on can tax those same dollars to the bone or leave them completely alone. Same money, same years of work that earned it. Wildly different outcome. Over a border you could drive across in an afternoon. Nobody handed you a manual for that part either. All right, here's exactly what to do with this step by step so you can act on it without rewinding. Number 1. Write down your 4 income types on one piece of paper. Social Security, pension, 401k and IRA withdrawals, and anything else like investment income or a part-time paycheck. You can't compare states until you know what you're actually living on. Number 2. Look up how your state, and any state you're dreaming about, treats each one of those 4. Go straight to the source. Search the name of the state plus Department of Revenue and find their page on retirement income and Social Security. Don't trust a blog with last year's numbers, and don't just trust me either. Confirm it at the state's own site for the current year, because these rules change almost every year. Several states already changed theirs for 2026. Number 3. Run the full picture. Not just the income tax line. Take the income tax you'd owe, then add the property tax on the kind of house you'd actually buy, the sales tax on what you actually spend, and a real home insurance quote for that actual address. Get that insurance quote before you fall in love with a place, especially anywhere near a coast. That one number has talked more people out of a move than any tax table ever has. Number 4. Before you sign anything or list the house, sit down with a fee-only fiduciary advisor. That's an advisor paid by you, not by a sale, and required to put your interest first. Bring your one piece of paper. Ask them to run your real numbers in your current state against the place you're considering. An hour of that can be worth thousands a year for the rest of your life. And one quick recap, because it matters. 4 income types. Check each one at the state's own website for this year. Add property, sales, and insurance to the math. Then get a fiduciary to pressure test it before you move a single box. If this cleared even a little of the fog, hit subscribe because I put out straight sourced breakdowns for exactly this chapter of life. And hit like if you've ever almost moved somewhere for the taxes alone. So here's the honest bottom line. There is no single best state for everyone. The right one depends on your 4 income types, your house, and how close you want to be to the people you love. The headline that says no income tax move here is selling you one corner of the picture and hoping you don't ask about the rest. You were never bad with this. The rules just got complicated, and nobody sat you down and walked you through them. Until now, run your own numbers. Check them at the source. Decide on the facts, not the bumper sticker. That's Gus. Honest answers for the years nobody hands you a manual for.